Welcome everybody, and you're back again with the Property Auction Hunters, and today we have yet another fantastic live stream for you. We are joined by Scott Marshall, Piotr Rusnik, and Safe Dersey, myself, Jay Howard, and it's amazing that we managed to get Scott. This is a big person in the industry. Scott joined us on the retreat last year and shared so much value that we couldn't wait to get him back again. We'll talk about that another time, but what we're going to do is we're just going to crack open his skull and find out what he knows. And today we're going to be talking about politics, the economy, flows of money. It's just going to go in many different places. But you want to be listening to these things because it's going to tell you about what's hot, what's not, what to expect, and how you should be behaving. And you'll be doing all of this outside of the rose-tinted glasses or the rage cage cell that people put their heads in, where they think, oh, everything's terrible, it's all burning down, everything's going to hell. It's not that bad, really. So, Scott, founder and CEO of Roma Finance.
Yeah, I'm delighted to be here, Jay. Thank you for the three of you for inviting me. Obviously, I enjoyed the retreat that I was on in Portugal last year. I think we're doing another one in a few weeks' time. Roma's delighted to be working with Hamad, working with the three of you, and the team that you're putting together, and the other people involved. And I think we've even developed new products for the people that are part of Hamad as part of the partnership that we are building with you. So it's great to be here.
We have had a couple of people approach us because word got out a little bit, and there are some very jealous people out there. So thank you very much for creating that environment. We've been enjoying it for a couple of weeks now.
Good. I think it's worth maybe just I suppose one of the things you want to hear from me is what my view is on the property market, the economy, what's going on, the world as I see it currently. If you watch the news, you see nothing but bad news. I think from an employer's perspective, it's challenging at the moment because employers' NIC has obviously gone up enormously. From our perspective as a business, it's costing us six figures. The additional costs, we've got to pass on those costs in some way, shape, or form to people. If you look at the big supermarkets, they've been the cost for them is enormous. They've been laying people off. Smaller businesses, leisure, tourism, travel. Hospitality, where they employ people on lower wages, they are really struggling at the moment because of the increase to the minimum wage, the workers' rights bills going through, as well as employers' NIC, and the fact the threshold has come down. It's costing them significantly more, and so you'll see that a lot of businesses that are employing lower wages will start to be shedding staff because actually it's where they've been marginal before. It's now made it extremely challenging for them to trade. So I think that from the jobs market perspective, it seems tougher right now. I think that if we're watching the news, we see job losses, we'll see businesses struggling, insolvencies will be going up, etc. However, let me give you an alternative perspective if I can, because what you might think is that may lead to recession, and recessions may lead to property price crashes or property price corrections. And I want to kind of give you a slightly alternative view on that, which I've only myself recently had my eyes opened to, which was not expected, to be fair. I was thinking that actually the world outside the UK would perceive the UK as a challenging place to do business because of the increased taxes. So corporation tax is now 25%, employers NI, lack of investment, the abolishment of the non-dom status, all those those types of things are discouraging foreign investment. But it's interesting, and something that Saif, I think you mentioned to me before, that we're seeing a lot of US nationals come and want to live in the UK, and so the UK is an attractive place for Americans to want to come and live, and yet we've abolished non-dom status, so the two don't quite go hand in hand. Something's going on. And I think the other thing that's happening generally is if we look at the UK's position, the UK obviously is outside the EU. Within the EU, the US is the EU is, some of the countries are having challenges. So France is having challenges, material challenges, particularly in the property market. Germany's having challenges, it's political challenges. You've seen, obviously, the election and the growth of the AfD within Germany and the political instability that's leading to. And they're having all sorts of challenges from an economic perspective. Italy is well known for the challenges that it has within its economy. So the fact that the UK is outside of the EU actually right now is advantageous. And it's advantageous from an overseas investment perspective. So if you want to be close to Europe, okay, but you don't want to be within Europe because of the challenges that are there right now, the UK offers a very attractive place to be. For the first time in, whether you agree with the politics or not, for the first time in 4 or 5 years, actually the UK's got a stable political environment. The London stock market. So go ahead, Piotr.
Yeah, I think that's what kind of makes auctions even going right now, because people tend to buy when things are fairly stable, even if they are stable, but not they don't approve of politics.
Yeah, we've lost Piotr there. I think. Jay, anything to add whilst waiting for Piotr to rejoin?
Yeah. I think this is it's a really interesting thing, right? Because there's a lot of legislation that's coming out, which kind of touches on many different things. You've got the leasehold, freehold kind of changes that are coming out. They need to be fixed. You've got renters' right reform bills. You've got all, and it touches every single part of like the property spectrum. But I think one of the things that Piotr was getting close to saying was, things are generally speaking stable. There's nothing that's coming in that hasn't been foreshadowed for some time. So, for the next 2 weeks and for the last 3 months, everyone's been talking about the changes to stamp duty. So everyone's been ramping up purchases under the current stamp duty, trying to get it in before April 1st. And what's going to happen on April 1st? Nothing. Maybe there'll be a slight correction in market values to account for the slight increase in stamp duty, but it's not really going to change a great deal. And whenever these things happen, it's always end of the world naysayers, Nostradamuses that are kind of coming out of the woodwork for seeing, that there's going to be a 10% correction in market values, and I just don't see it happening. Yeah. I see the market is.
The interesting thing, Jay, on that point as well, is over the last probably couple of weeks, even couple of months, the amount of people that have said to me, because we trade, so we crystallize profits, and we have corporation tax that we pay, which, as everyone knows, is 25% now. Plus, you've got linked companies and stuff, which obviously have to pay corporation tax forward, etc. But the point is, everyone's been saying, why don't you move to Dubai? Why don't you move to Dubai because of tax reasons? And I thought about this long and hard, and the reality is, I love the UK has a hustle work culture that you cannot find anywhere else, right? You can start from a stop-start point of view, make a lot of money really quickly doing anything you want. We have this we buy need culture, we have the lending, we have so many different cultures in the UK, which allows people to go from nothing to obviously making money, whereas a lot of the other environments don't allow for that. The reality is we've got to pay our taxes, we've got to get on with things, and there's always going to be change. But I think it's always the devil you know than the one that you don't, if that makes sense. So that's why, for me, I still think the UK has a lot of advantage over a lot of other countries, like Scott was saying as well on that point.
Well, and there's a social responsibility, to paying taxes. Okay, things haven't been fantastic for the last 30 odd years, and before then it wasn't great, but even then, there is a responsibility to a country that you're in to be able to pay into it.
I think that's not the issue. The issue is that we today have 3 times as many people claiming welfare than we did 10 years ago. Okay, and so if that trend continues, it is completely unsustainable. And so the irony is it's going to be a Labour left-wing government that's going to have to drive down the welfare state because it's too big and it's unsustainable. It can't continue. So you're going to see, interestingly, there are going to be massive swathes of cuts across welfare, and that will hopefully help to put the brakes on the increases in taxes that we're all suffering at the moment. But what I was trying to go on to say before was that from an outside perspective, obviously we talked about Americans coming into the UK, and we've talked about the UK being outside the EU as an interesting place to come and invest in. The other piece that's interesting right now is that the UK stock market is materially undervalued by comparison with the Nasdaq and the S&P in the States and the US stock market. So all of a sudden, British companies seem cheap. Okay, they seem cheap, and they are cheap. So the UK is seen as a place where there is, number one, political stability, and people outside the UK, they don't see the minutiae of granular detail that we see around taxes, around stamp duty, around employers NI, etc. They just see that the UK political stability, been around a long time, it's going to be around for forever, attractive place to do business, on the gateway to Europe. So it might cost us a little bit more to get into Europe, but at least there's stability. And inside the EU, there is political instability right now. So the way that, again, with the work that I do, I see lots of overseas interest in the UK. And there is a wall of money that is on its way to the UK to buy businesses, to buy property, and to invest. And it's interesting. So if you're seeing it from a people perspective, that US nationals are wanting to come to the UK, but there's also lots of Middle Eastern money that's wanting to come into the UK as well to invest. So we see Dubai. You mentioned Dubai as relocating there, but actually there's also lots of Middle Eastern money wanting to come into the UK because assets right now are cheap. We've had a weak pound for a long time, probably since Brexit. Okay, so there's been a very weak pound for 10 years. That makes our properties cheap. It makes our companies cheap. It makes our assets cheap. And given the fact that there is instability right now in the US, you've got a dollar which is likely to weaken over the next few years, which will be to the benefit of sterling, particularly if the euro is not going to be strong given the instability within the EU. So if we look at where the pound is like, and this is all very relevant, because what will happen is people investing in the UK, all of a sudden they'll see growth naturally, even if there's no actual inflation within the asset prices. They will see that their pound will go further. Their investment will go up in value, even if it doesn't go up in value over here because of the currencies that they're buying in. So we're going to see, I think, a lot of investment in the UK because it's the best time to do business. I always say this is a counter-cyclical environment. Okay, the media talk in the UK. We have for some reason we are incredibly self-deprecating. We seem to love to always be the givers of bad news. In America, they celebrate success. Okay, and we should be better and stronger at celebrating our own successes. The UK is not the basket case that the media lead us to believe. It's actually somewhere where lots of people want to invest, want to do business, and want to own assets. And I think we will see British businesses do well. We'll see British property do well. And it doesn't matter what sector you're in. If we are talking ourselves down right now, then actually it's a fantastic time to buy. I know that some of you're finding the auctions more challenging from a buying perspective because there's so much that's being sold to other people. But it doesn't mean that the asset prices are yet doing that. Going up, but they are very likely to because you've got a stable political and
stability is all the market wants. If you have 3 to 5% increases year on year, that's a very, very good market in my eyes. Even a 2 to 3% market stability is good, and that stability means that people have confidence, and when people have confidence, they're willing to buy. So it's not necessarily just about the price, but it's also about the fact that there's transactions happening in the economy. So buying, selling, stamp duty, all of this obviously creates a market. But on that point, Scott, I guess my point that I want to come to is you as a lender, but also as a lender with multiple hats on, looking at things from different eyes. Where do you see the UK property market specifically over the next year?
Yeah. So let me first of all deal with what lots of people, so-called experts, have been talking about in terms of there being a property crash. I think it is highly likely, almost improbable, that there's going to be a property price correction in the UK. And I'll give you some reasons why. The first one is there's political stability. Number two, the reason why 2008 happened was because, number one, the banks had no money. They were materially undercapitalized. Number two, people had been sold self-certifying mortgages where the affordability hadn't been checked at high loan to values. And number before was that whole subprime merry-go-round was effectively going on throughout Western economies, the US in particular, and the failure of those the lenders over in the US meant there was contagion in the UK, and the music stopped. Okay, the situation we're in right now is completely different. So number one, the banks are the trading arms and the retail arms of the banks have been separated. So the risky part is nothing to do now with the retail part. The retail part, they have there's been much more stringent capital adequacy tests that have been introduced into the banks. So the banks are actually materially overcapitalized and well capitalized, which means that they can absorb any issues. And I'll come back to that in a second. The second point is that the weighted average loan to values of property in the UK for mortgages is around 40%. Okay, so if their customers have got any stress, there is so much material headroom where where banks and lenders can effectively capitalize arrears into a higher balance whilst customers get on their feet. So there isn't, and because the banks had so little cash 15 years ago, or now 17 years ago, almost 20 years ago, because they had so little cash, they themselves had to go on a cash grab to repossess properties, to sell them quickly to strengthen their own balance sheets. They're not in that situation. The banks are not in that situation now. They don't need to go grabbing cash from ordinary people because they've got plenty. And so weighted average loan to values are materially lower. Number two, so bye, have a nice evening, see you later. Bye. So weighted average loan to values are lower. The banks have got material cash. There's still a shortage of property. The next thing is that there's been a massive increase in the number of homes that are owned outright. So the number of mortgages on residential property has materially dropped since the start of COVID. In fact, even since before COVID in 2019. So I mean, I could share a graph another time, and maybe I'll do this when I'm in Portugal with you guys to kind of show some of the data that sits behind this, where you can see that the number of homes with mortgages has dropped by almost 10% in the past few years. The number of properties without mortgages has materially increased. So the banks are better capitalized, but also we as the public are generally better capitalized and more asset rich than we were. So link that to the fact that when banks are providing mortgages, they've got to stress test at 5% over the pay rate of the mortgage, means that also mortgages become much more affordable for people, even if their income were to vary. So there's a whole series of checks and balances that have been introduced into the mortgage market, which has led to me saying now that, you know, even though interest rates have went up from 0.1% in December 2021 to 5.25% in August last year when they peaked, actually, and that's almost a 5,000% increase. Actually, there may have been some stress that was introduced into the market, but there was no material distress, not like we saw 20 years ago, because of all the checks and balances that were and the banks and, you know, a weighted average LTV. So banks could, and they were able to find ways in which they could support their customers that were in a stress situation. And you know, that's why one of the reasons why, some of the reasons why we haven't, and we're unlikely to see a property crash. The next point as well is that as a result of COVID, there are now there's now £300 billion worth of savings. So the general public have got huge amounts of cash that's stored away when you know, they had little to spend it on, and that cash has not yet been released back into the economy. And so people, if they've got stress and things change, they've generally got more wool on their back to trade through a more challenging environment themselves before they even have to go and ask a bank or mortgage company for help, should they have a mortgage to begin with.
Do you think that's like could that be an inflationary thing if that money was to flood into the market all of a sudden?
I think that what's really interesting is if you look at what the government did with the last budget, from inheritance by, for example, bringing pensions into inheritance tax, the part of the inheritance tax estate. What that will do is it will encourage those with pensions who are now going to get taxed by passing it on to the next generation. They're encouraged to spend it. So again, you've got this wall of overseas money coming into the UK to invest in the UK, but you've also got the blue rinse or grey hair, or people that maybe are slightly older than I am, who are saying, well, actually, I might as well maybe a few years older, but I might as well either spend it myself or give it with a warm hand rather than a cold hand, because it's going to make no difference to the estate that I pass on. So I might as well enjoy myself.
Yeah, and the interesting thing with that as well is, certainly as a trader, I don't really care what's going on with the market too far ahead. I'm really looking at 3 to 4 months ahead. That's all I'm interested in. The problem is a lot of people get too wound up about, is the market going to crash? Is there going to be a change? Is there going to be a correction? And the reality is, if you keep thinking that way, you're never going to do deals. You're never going to be able to do anything. So you've got to go with the mindset of, every day is a good day for trading. Every day is a good day for buying anything, business, assets in general. As long as you buy well, you can always sell. And that is the key for anything really that we're doing in this industry.
Every business is the same. I don't care whether you are making widgets or you are trading property. If you buy well, you can sell well. You're 100% right. And you buy better in a counter-cyclical environment. So look at what is not, what is, okay, it's almost like you need to look at a demand. So to look at where demand is the strongest, but there's the least amount of transactions.
Yeah. Totally.
Well, I spoke at an event yesterday evening, and somebody said, well, where do you see an opportunity in the market that people just aren't really focusing on? And at auctions at the moment, and I suspect mainly in the main market through estate agents, I think apartments, 1, 2, 3 bed apartments are sticky. For a trader, they're just not moving. And these could just be very vanilla, decent lease length, no ESW ones, no Section 20 major work bills, just very simple flats, and they're not selling. So you kind of want to start thinking about taking a contrarian view. There are a couple auction sites where these flats are relisted, and every time they're relisted, the price goes down £20,000. But it has to get to a point where if you have the capital and you have access to the debt to kind of fund it with and put tenants in them, because they're tenanted, they're perfectly tenantable, lettable, you have to start thinking it's going to get to a price point where it's almost stupid to not be picking up these sticky assets that other people don't really want to get their hands dirty with.
Does it depend on what someone's sort of investment strategy is? So if someone's wanting to buy and hold and they're looking for yield, then actually flats might be great cash cows because they can be bought cheap with a greater yield, and people can hold them for some time. Whereas actually, if people are trading and there isn't the market and Cypher is looking 4 months down the track, it's unlikely there's going to be a market created within 3 or 4 months for those types of assets.
I mean,
you could almost treat it as land banking. A trader, if they can get their hands on in fairly prime cities in the UK or London, Manchester, Liverpool, wherever they're going, they could be sitting here thinking, well, if I can set aside £1 million and buy 15 flats or whatever it may be, because they're cheap, and just hold them for a year, rent them. And then as the sentiment turns, it becomes more of a long-term flip than a quick trade. So there is potentially utility there for a trader, but not if the trader is thinking, I'm buying this to trade it straight away.
We're seeing,
an asset management play.
Yeah, it's interesting that you say that, Jay, because we are seeing at the moment lots of portfolio transactions. So people are coming to us to say, I'm buying 15 properties. And we'll do effectively one loan across the entire portfolio. And it may be that smaller landlords are wanting to exit the market because of the change in regulation, change in tax, blah, blah, blah. But new people coming in or existing people looking to grow their portfolio that are running them as professional businesses, they're seeing the great buying opportunities. Maybe the ones and twos at the auctions obviously more competitive right now, but the portfolios we're seeing good traffic on those.
Do you just out of interest? Obviously, you've got everything with the rent reform bill and all the changes and stuff. Are you seeing that your valuations on the portfolios on the tenanted stuff is starting to come down versus your vacant possession values, just out of interest, i.e. if it's harder to obviously get the tenants out, the value is attributed to that asset is lower than if it was vacant already and if your buyer was buying it?
That's a really good question. The vast majority, so ignoring the portfolios for a second, because people will only tend to buy portfolios if they can buy the portfolio at a deep discount.
Correct.
Because they're buying in bulk. But if we look at the majority of the transactions that we're still doing, the majority are vacant possession, where there's some kind of distress within the asset that somebody is trying to fix in order to add value. They're buying better in the current market, number one. Number two, because the bottom isn't going to fall out of the market, and I think that's what I believe, and I think that's what the three of you believe as well. That actually they've got and they're able to turn them quickly, 6 to, you say 3 to 4 months. I've got a slightly longer horizon, maybe 6 to 9 months. There's very much a market for those, and people, the fixes and flips, the doer-uppers, those are fantastic opportunities. But the amateurs, and I come on to how the profile of our customers has changed over the past sort of 2 or 3 years. The amateurs seem to have left the market more recently, and the pros are cleaning up.
So what's been typical kind of profile of your obviously clients, and obviously in the past you used to focus a lot on development, but now you're quite big into the auction space. How's this affecting your typical client?
So if I think that Roma, we call it the Roma persona. Okay, so we've got we've always had 3 Roma personas, and most customers will sit in one of these 3 boxes. And I'll try and simplify them if I can. So the first Roma persona is the blue collar worker who is on the tools. So it will be a builder, a carpenter, an electrician, a plumber, someone who's, with their mates can do a lot of the work themselves. Okay, and they will go and they will buy something that's in need of some TLC to add some value, and they will just rinse and repeat. But they tend to be, won't be buying in volume. They'll be buying, 1 or 2 a year and just and rolling. Those people are very much in the market at the moment because they can buy well. They'll always be in the market, and there's always projects to be done. The bottoms will fall out, and they tend to also have a lot of cash as well. Okay. The second type of customer we have is the white collar property professional, so QS, landlord, property trader. Okay, they are absolutely, there is a lot of business in that space at the moment. Loads and loads of those types of people are doing business. The third type of person is the white collar non-property person that's trying to create some passive wealth and passive income on the side. So doctor, dentist, lawyer, pilot, surgeon, IT, FD, that type of person. They've fallen away as interest rates have gone up and cost of materials have gone up. Those people have fallen away, and those people realize that development is quite hard, and they don't have the skill set to go on property trade or the time to go on property trade. And so we've seen that Roma personas number 1 and number 2, which are real sort of, people that know and understand property, whether it's from a technical competence perspective or from a professional trading perspective or landlord perspective. Those types of people are very, very active in the market at the moment. And those are the ones that have really come back into the market, particularly the professional landlord types and white collar people, as the non-specialists have kind of fallen away over the past few years as interest rates have gone up. So we've seen our demographic change. And interesting, that suits us better in many ways because you tend to have less problems with people that are more experienced within property.
Yeah. Just a quick question, and it harkens back to you're seeing more transactions of portfolios at the moment.
Yeah.
You may not have the answer, but my initial reaction when you said that was, that sounds like retiring landlords selling en masse. Is that what we're dealing with there, or is it that's it?
Yeah. You know, if you think that you are, if you are in your 60s or 70s, and residential is hard work. Unless you're having to manage for you, it's hard. It's a full-time job dealing with a significant portfolio. If your kids are successful in other spaces and they don't need the properties and the income, actually better to give them cash. So we are seeing that older landlords who are looking to retire don't want the hassle of having to deal with lots of tenants within a portfolio. So yes, those people are selling. And don't forget, they've been buying over the years, so they've got some capital appreciation, have had a great income, but they just don't want to be managing them as regulations are tightening going forward. The other interesting thing that's going to change, I think, and I'm not sure that people are aware of this, which is why this is good from a trading perspective, is that the Basel 3.0, which I'm sure you people may have heard of, but don't really know what it means. Basel 3.0 is coming in 2027. And what Basel 3.0 is going to say is that those lenders that are, or the banks and building societies that are lending into the buy-to-let space, rather than the properties being treated from a capital perspective as residential, they're going to be treated as a capital perspective as commercial. So the capital they've got to put aside for those buy-to-let mortgages is going to be 3 times what it is now, which means that buy-to-let mortgages are likely to go up, or it will invite other entrants into the market. So we will probably see that that non-banks and non-building societies will become much more aggressive in that space because they'll be able to compete from a capital perspective with cheaper products. So it might be, for example, that insurers might want to enter the space. Insurance companies might enter the space as mortgage lenders rather than it being banks and building societies and centralized lenders. So we're going to see some changes into where people get their money from within the next 2 or 3 years.
Does this also affect where sort of lenders get their money from? Because obviously, like those big banks and the insurance companies might be like lending the money, providing facilities. Is it also affecting how that might change?
Well, it depends on how the money is introduced. So if I think about where we get our money from, we're generally, we've got different lines with different products, but essentially that will not affect, or should not affect us. From a bridging space, from lending to property traders, from the Hunter's License product that we've recently launched, even our buy-to-let, it shouldn't affect us, but obviously it remains to be seen.
Really good.
Just one question I had, Scott.
Go on.
Yeah, I was just going to say just regarding sort of, I guess, trading specifically as well. So when you are doing a trading specific product, if you want to call it that, a lot of people are wanting speed, right? So that's the key. When we're buying as a trader, it's all about the lowest friction to get to that completion, right? Typically, we're dealing with direct to vendor. We might be dealing with auction. There is always a restriction on the time frame of when we are buying, and potentially restriction on getting access to the properties and stuff like that. What's your stance generally on desktop valuations versus physical? What's your stance generally on things like, looking at it to try and obviously simplify things dual rep? Because it's something that everyone talks about, and I think it's something that you need to talk openly about, because obviously understanding that will reduce a lot of the friction points for a lot of people when they are getting the lending.
So I think that there are three things that lenders can do to help this part of the market, and we are working on all three. Okay, so the first one, you're right, AVMs, because waiting for a physical valuation on a property can be it can make a deal fall over. So AVMs, we've been using AVM since the start of COVID, and it's now a significant part of our business and growing. And the work that we're doing with AVM technology, without wanting to go into too much detail right now, the work that we're doing with AVM technology is incredibly interesting, and we're very much we have been pioneers in the market, and we will continue to be pioneers in the market in the way that we use AVM and desktops. So that's number one. Number two, on the side of dual rep, we from a process perspective, dual rep I think is very, very important to a property trader, because you need to be, again, you know what you're doing, you know the risks, you know the titles, etc., etc. So on a dual rep side, what we're doing with dual rep at the moment is we're working with a panel of lawyers that are prepared to act for both parties. So we won't allow the borrower's lawyer to act for both parties, but our lawyers will. Okay, so that's how we are solving that one. And then the third aspect, which is something that you've not raised, but I'd like to raise it if you don't mind, is that where you are lending into SPVs, where there's lots of other things going on, lots of lenders often require debentures over the SPV that can delay transactions, particularly if there's other debt in those SPVs. We don't. So for bridging and property trading type people, we don't require debentures. So AVMs, dual rep, and no debentures. And those, I think, are the three ways in which we can materially, we have, and we are speeding up transactions.
Brilliant.
If you had to pull it right out of thin air, Scott, what would you think are the top three things that would destabilize the economy? Like that there is a reasonable chance of happening. We're not talking about four horsemen of the apocalypse turning up for
we're trying to be positive here, Jay.
But no, I mean, because we're all kind of bullish on the market, and I think it's important that people see that representation. It's a good chat to have, but there also has to be the, well, what if, but I mean, you're the type of person, I think, Scott, that even if you have the what if, you would say, well, it could be handled in such a way to reduce its impact.
So if you ignore the challenging geopolitical environment at the moment, and by the way, if you want to touch on that, I don't see that the biggest threat to the property market is Trump and US politics. I think the biggest threat to the property market actually are the Iranians, the Russians, and the Chinese. Okay, and actually keeping those countries in check is the biggest single thing that will ensure long-term stability for Western economies. From a UK perspective, unemployment is always the biggest thing to watch, because where unemployment goes up, and if it goes up materially, then the Bank of England will have to step in to reduce interest rates ahead of any controls on inflation, and that will lead to further. I think I touched on this when I was in Portugal last time I came, and I'll talk about it a bit more when I come next month. Where you are reducing interest rates ahead of what happens with the Fed in America, that in itself can be inflationary, because it can devalue, or it can effectively push up the cost of imports. And because most current commodities are traded in dollars. So we've really got to watch the unemployment figures. Where you see the unemployment figures start to rise, then potentially that could lead to falls in property prices, for not just for currency reasons, but also because of people, buyer sentiment is one of the biggest reasons why there's people stop spending money. And the way in which an economy does well, forget all the stats. Actually, what's most important is how people feel. So if you feel secure in your job, you will go and spend money on holidays, restaurants, and there'll be discretionary spending. If you don't feel secure in your job, and you feel vulnerable, then you'll rein things in. Okay, and so ensuring that there is, which is why I think the budget was so bad, because it makes people feel insecure in their jobs because of the way in which employers have been talking since the budget last year. So unemployment, ignoring geopolitics, unemployment is the biggest single thing that can cause property prices to reduce in the UK. And I know I've said that actually I'm bullish on property prices, and I am, but that is because there's so many other factors at play, which mean that the UK actually is an interesting place for overseas companies to invest right now.
Interestingly, talking about the intangible things that affect markets as well, and we see it in auctions all the time when we're selling. Just when the sunshine comes out, just when people are starting to feel positive, they just bid that bit more for properties. They are just a bit more bullish on buying. There is a feel-good factor about when the sunshine comes out in the UK. It's a bit warmer, and people just feel good. When people feel good, they are in the mood. And it's the same with anything. If you're busy, if you're stressed out, sometimes you think, you know what, I'm not going to bid on this because I've got too much going on in my life right now. So it's really interesting to see that there's intangible things that affect the property market as well.
Sentiment is everything. So if people feel confident, they spend money. If people don't feel confident, they don't. And if people don't spend money, that is what can lead to the economy contracting. And the media have got a big part to play in actually the feel-good factor that we all, we should be feeling right now, because we've got that stability politically that we've not had for many years. So
it was very much a Boris Johnson thing, wasn't it? Boris Johnson was very much.
But this is very much why it actually is a fantastic time to be a property trader right now, because the bottom is not going to fall out of the market.
Yeah, brilliant. And we're looking forward to having you on the retreat and having those conversations in more depth on the retreat. It's coming up in just under 4 weeks' time.
Wow.
Yeah, but just from the last one, I think what I enjoyed the most was the whole kind of market overview that you delivered, and the big picture that sometimes it's necessary to have the positive attitude about the market, and it doesn't always impact the trading straight away, but it gives that back of the mind peace of mind that things are going to be okay, and then it allows people to focus on the nitty-gritty of actual trades rather than thinking in the back of their mind what's going to happen, is this going to be okay, and should I be trading, should I not be trading. So I think that was on the last retreat, that was the key takeaway that I got from your talk.
Thank you. I'm looking forward to it myself.
Yeah, brilliant. Well, thank you for taking valuable time out of your business and family life, I guess, at 7:42 p.m. But we're looking forward to having you on the retreat, and we're looking forward to doing more stuff with Roma.
Brilliant. Likewise. Many thanks. Thanks for having me, guys.
And
thank you very much.
Yeah, thanks everyone for watching. And if you have any questions, drop them in the comments, and we'll make sure we respond. Good night.